Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Dane. We're counting down to the next VRIC, January 21st and 22nd. There's a link below in the description where you can get your tickets. And today's guest is a former intelligence analyst for the CIA and Department of Defense and the founder of iGold Advisor, providing independent research and analytics on all aspects of the precious metals market. It's Christopher Aaron. Welcome to the show.
Jesse, thank you much. Thank you for having me.
Thank you for being here. And I want to start with a broader question, which is what are the main tailwinds that you currently see working in the favor of both gold and silver as we sit here today?
Yeah, so fundamentally speaking, we have two major catalysts on the horizon for precious metals. And just as a backdrop, I am wearing my Veterans for Peace shirt today. I do approach this from a military intelligence backdrop. Going back into my career, in my former career, it was what are the most important things happening right now? Provide that information to the military leaders so that they can make appropriate decisions. So when we look at the precious metals right now, and we talk about gold that has been consolidating for 3 years, plus or minus a few months on each side. 3 years, gold has been in this giant trading range between the 1600s and 2075. And it would be very, very rare to see a market consolidate like that for 3 years and then top out. That would be rare. We can never say never in the investment world. But I look at this market, I look at the fundamental backdrops, and I say something is coming that is going to cause gold to break out to at least one more significant peak here over the next 1 to 2 years. Something is going to cause the spark, cause the trigger. So I see it back to that analogy of the military analysis. I see the what. And then the market finds a way of filling in the why. Why is it going to happen? In my assessment, the why for gold, why is it going to break out, is either going to come down to monetary policy reversal by the Federal Reserve. We did see what looks to be like the last major interest rate hike by the Fed just yesterday, another 1/4 percentage point hike. And the market right now is pricing in next spring, it looks like March of next year, the reversal of that policy, the beginning of the tapering of interest rates, bringing rates back down. That's the first potential that could cause gold to break out. The second major one is, unfortunately, what we do see sometimes in the world, a geopolitical based trigger. We can look at the invasion of Ukraine by Russia. We can look all the way back to the terrorist attacks in 2001, and we can see that these geopolitical events often cause significant spikes in the price of gold. You juxtapose that knowledge on the fact that gold has been moving sideways here for the last 3 years, and it looks to me like there's the distinct possibility that some sort of an escalation between Russia, Ukraine, possibly even involving a tactical nuclear weapon or an expansion into the rest of NATO, could be that secondary trigger.
So I wanted to outline a few things you've been discussing recently, and you mentioned some battles occurring between gold and a couple of other asset classes, the first being US bonds. So could you tell us what you're seeing there?
Yeah, it's really important for precious metals investors to remember that gold fights two battles simultaneously. We often think of the primary battle of gold versus fiat currency, and of course the world's reserve currency, which is US dollars. So we think of this as the primary battle. It's the historic form of money versus fiat money. And this is indeed a legitimate battle that gold is facing. We'll talk about this one first, and then we'll talk about the second battle that gold is facing simultaneously. But the first one, gold versus bonds, is sort of the definition of the tangible form of wealth versus the government issued, government printed form of wealth. I mean, Bonds are just a piece of paper that say, hey, at some point in the future, we promise to pay you back. And when we look at this, and I'm happy to provide this chart for reference, maybe there's a way that we can pull up this chart with the interview. But when we look at the history of gold versus bonds, specifically the longest duration bond in the United States, the 30-year bond, what we see is that gold is actually breaking out as we are speaking. It's breaking upward versus bonds, a level that has never before been seen ever in the history of mankind. Gold is now worth more than it has ever been worth compared to these fiat bonds. And so typically when we see something like this, we're talking a 40 to 45 year consolidation that's been going on here. And then you see a market breaking upward. That doesn't resolve itself in just a year or 2 years. That tends to mean that there's a multi-year, perhaps even a multi-decade period of time ahead in which gold is going to continue outperforming fiat assets. So it's very important for precious metals investors to understand that is happening. However, it's not enough for precious metals to be outperforming fiat assets. There is another battle happening simultaneously, exact same time, that if you're not paying attention to, you will be too narrow-sighted in your focus as to the broad landscape of investments that are happening in the world. That second battle is gold versus stocks, gold versus the S&P 500, or in the case that I like to refer to because it's the longest dated index that we have, we talk about gold versus the Dow Jones Industrial Average. The Dow Jones Industrial Average, or the Dow for short, goes back to the 1800s. We have over 160 years of data available to us. And when we look at the gold versus the Dow, in other words, we're talking about a store of wealth versus industry versus productive capacity. What we see is a convergence here over the last 10 years or so. And in fact, if we draw that chart outward, we can see that convergence has been going on really for the last 30 to 35 years. So these convergences where you have the highs coming down, you have the lows coming up, and really over the last several years, it's been moving very flat. In other words, Dow versus the gold has been moving nearly sideways for the last 8 years here. That's an anomaly. It's not typical for Dow and industrial capacity to be moving even with the age-old store of wealth. And so what I'm arguing here is that even as we've demonstrated, you can see it in the chart, that gold is outperforming fiat assets, bonds, and it's going to continue to do so. We still have to reserve some judgment here because this 35 to 40 year consolidation between gold and the Dow, that has yet to be resolved. And there is a scenario by which gold could continue to outperform fiat assets. But in the landscape of a store of wealth versus productive capacity, it is possible that gold underperforms the productive capacity of society as a whole, even as it is outpacing the fiat assets.
So you also noted that there's a negative divergence when looking at the gold price and the GDX. Could you expand on that and explain why investors should be paying attention to that?
Yeah, so the GDX is the large cap gold miners fund. It's a basket of about 50 different gold mining stocks. And we have pretty good data for this going back to 2006. Specifically, if we look at the period of time here from 2016 through the present, so let's call it the last 7 years, we have the GDX currently trading in the same range as it was in 2016, around the 30 to 31 level on the index. Okay, so as a net sum, the GDX has moved sideways since 2016. Meanwhile, gold is $500 higher than it was in 2016 at the same time when the GDX was at this 30 to 31 level. So what this shows you is that as a net sum, yes, there are a few exceptions, but as a net sum, the gold miners have underperformed quite dramatically here as gold has moved to these new records, including new all-time highs. That is what we call negative divergence between gold miners and gold. The last major time that this happened was in 2010 to 2011. If we go back and look at the data from the GDX to gold, back in that period, the GDX topped out around 60 to 61 on the index back in 2010, and it moved sideways for about a year, even as gold moved from 1400 up to 1900. So a very similar kind of underperformance where you have the GDX moving sideways, gold rising by about $500. And unfortunately, back then in 2011, what that underperformance represented was a top pending for the price of gold. It was essentially the investors in the large cap gold mining shares saying, we don't believe that this price of gold is going to last. Therefore, we're going to not invest in more gold mining, even as gold itself was moving higher. It was a predictive capacity of the sum of the gold mining investors. So we see the same negative divergence developing today. The challenge, however, is when I look at the gold chart in isolation, and if investors have a chance to go back and look at my talk from the actual Vancouver show live, which is available for free on the VRIC website as well as my own website, you will see that I was talking back then in January about this consolidation in gold, and that when we look at gold in isolation, it's still a bullish looking chart. And it looks like gold, we talked about this a few months ago, Jesse, it looks like gold wants to break out one more time. It looks like gold wants to make one more significant peak. It could even be quite dramatic. This could be a move to the mid 2000s, upper 2000s, depending on what the actual spark is for gold. So we juxtapose these two things. We have the underperformance in the gold mining sector. We have gold itself that looks like it wants to break out. The best takeaway, if I was to be giving this brief to a military commander, as I did in Afghanistan in 2006 and 2009, I would say we see these diverse set of facts. We see gold miners underperforming. We see gold that looks like it wants to break out. It looks like there's going to be one more significant wave higher in the price of gold, could be quite dramatic. And then perhaps within the next 12 to 18 months, that wave higher represents a final significant top for gold for perhaps a number of years. And so we should be following this very closely as we get into 2024, perhaps early 2025, to either confirm or deny the information that we are observing right here.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday, and I love writing it. Hit that link below to subscribe. All right, back to the interview.
When it comes to the gold and silver mining sector, is there anywhere at the moment, aside from the index, that you're seeing the most opportunity in right now? You know, a lot of the junior mining companies look especially undervalued. A lot of investors seem to be actually throwing in the towel these days when it comes to the gold and silver sector. Do the explorers, the developers, producers, royalty companies, where are you looking for value right now in that sector?
Yeah, that's a good point. So right now, even though the entire sector is undervalued, we just talked about the negative divergence. So the entire sector is undervalued actually by several orders of magnitude. I would say the stocks that are closer to proper valued tend to be the larger companies, especially the streamers and the royalty companies, and then a few select names of the large cap producers. They're closer to where they should be. So if I'm looking at this and saying, hey, there could be one significant further wave to come in gold over the next 12 to 18 months, I want to look at what has the chance of playing catch up to the highest leverage effect over this intermediate term. So I'm going to argue it's not the large cap producers. It's not the streamers. Those companies have done fine over the last number of years. Congratulations if you've been in them. But if you're looking for the opportunity to really, if you think about this, like there's this pitch coming, to use the baseball analogy, we can see the pitch coming. The pitcher is on the mound. We know he's going to send a fastball down the plate. We've been tipped off to this by our scouts in the field. We know this is coming toward us, and we want to try to hit a home run on this. The most undervalued companies where the risk-adjusted return is most favorable for us as investors right now is in the development stage companies that have defined resources in the ground. We're talking about companies that may be sitting on 1 million, 2 million ounces of gold. It's already demonstrated. It's in either the proven and probable or the measured and indicated categories. So we're not talking hypothetical gold. That gold I see being sold when we look at market cap valuations. That gold is being sold for around the industry $5 to $10 per ounce. When we look at the last cycle in 2011, what were these very same companies being sold for? The same deposits in the ground, the same price of gold above ground. These companies were being sold for $50 to $100 per ounce in the ground. We're talking in the range of 10 times the valuation when we go back just 10 years ago, once again, for the same price of the underlying bullion and the same companies. So if I'm looking at this and I'm saying, well, I would like in this wave higher to really try to hit that home run, to really try to hit this pitch and change my possibilities in life, perhaps forever, because you only need to be right once to change your possibilities in life forever. I would say that it's the development stage companies, perhaps to include also a very small segment of the advanced exploration companies, the companies that have done a significant amount of drilling where they know there's a resource in the ground, but let's say they're just 6 to 12 months away from actually publishing the study to confirm that. I think that's the sweet spot right now that investors should be focusing on for this next potential wave higher.
Let's talk about the last Fed FOMC meeting where they hiked rates by 25 basis points. This was highly expected. We have Powell stating, I would say it's certainly possible that we will raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady and we're going to be making careful assessments. Leave it to central bankers to say two things at once and give you zero information whatsoever. But I'm wondering what you make of the Fed's latest move and how you see things playing out moving forward.
Yeah, so I mean, the meeting itself was really a non-meeting yesterday. I think you said it exactly right, Jesse. It's there was just a lot of nondescript language about the next several meetings coming forward. The reporters tried. It was quite interesting actually to watch the reporters ask basically the same question in 4 or 5 different kind of ways to Jerome Powell. It was like, hey, so what do you think is going to happen at the September meeting? And he said, I'm going to wait for the data to come in. And then the next reporter would say, what do you think about the November meeting? I'm going to wait for the data to come in. So he kept saying the same thing. The best that we can do as investors right now is really to look at the market expectations. So you've got Jerome Powell saying what he needs to say, and he has his vested interest. You've got the reporters that are trying to find little nuggets here and there. But I think we look at the market expectation. The market is not always right 100% of the time, but it does give us a good guidance. It at least gives us a framework to study over the next 6 to 12 months. Right now, if we look at the market expectations, the market is predicting a pause from now through next March. So basically, we're talking 6 to 8 months of steady interest rates. And then the next cutting cycle beginning in March of next year. Now, it's possible that in this prediction by the market of even interest rates for the next 6 to 8 months, it's possible that the market gets faked out one time. So perhaps there's one final rate hike to come even in September or November. But if there is one more, I think that's going to be the last one. So perhaps rates get up to 5.5%, 5.75%. The market has it slightly off, but then I think the market is going to be correct when we look out getting 6, 8, 12 months into the future. That starting first quarter into the second quarter of next year, we get the beginning of the rate cut cycle. It will remain to be seen how far they cut rates. Is this only cut rates from 5.5 down to 4.5 or 4%? Do they slash rates all the way back down to 0 again, or even some sort of negative territory? That remains to be seen. The last piece of constructive data that I'll just give you on the Fed. One of our clients here actually suggested that we go back and review all of the previous Fed rate cut cycles in freely traded gold history. So going back to 1971, looking at every single time that the Fed has in fact cut rates. And I went and did this on my own time with a fine-tooth comb. And I proved, based on the historical analysis, that if you average out the sum of the previous rate cut cycles across all the major world asset classes, you talk about stocks, you talk about physical metals, you talk about bonds. On average, the best performing asset class for the first 12 months of a new rate cut cycle is, in fact, the gold and silver mining sector. This goes back all the way to the 1970s. So we're averaging about 8 different rate cut cycles. The miners are indeed the best performing for the first year after that. Now, it's possible that outperformance could be similar to a final wave, perhaps even a blow-off wave like we saw 1979 to 1980, in which the miners outperformed quite dramatically for a year or 18 months. We have to reserve judgment after that point. Does it represent a top at that point? Even if it does represent a top, the historical evidence shows that the mining sector is typically best performing when we're looking out to the start of the rate cut cycle next spring.
So you've alluded to this a few times throughout the interview, but maybe I wanted to have you expand on it. And that is how your experience as an intelligence analyst for the CIA and Department of Defense and your deployments in the military have helped you as an investor and market analyst.
Yeah, thanks for that question, Jesse. It's kind of a personal question, and there are two primary takeaways that I will give to this. One, on the personal side, is I saw with my own 2 eyes the amount of waste and the amount of destruction that was happening overseas based on these unwinnable wars. I personally was involved in the military drone program for the CIA, and we were flying these drones over Afghanistan and Iraq, and we were looking down on the ground and deciding where to drop bombs. And I saw with my own 2 eyes, even though I am a patriot and I love freedom, I love what the United States and the West stands for. I saw with my own 2 eyes that the policy of continuing to drop bombs on people, even if they are ideologically opposed to us, that strategy was resulting in less stability, less security in the world, and in fact, a waste of resources. And so when I look at what is happening today between Russia and Ukraine, it's not to say that I support either side or the war. Of course, I want the war to end. I want Russia to withdraw. But that said, the policy that we are pursuing right now as a country of continuing to just pump money, hundreds of billions of dollars every several months, going to weapons manufacturing, going to ship weapons over there into the wars, this is highly, highly reminiscent of the policy that we were pursuing in the unwinnable wars that I participated in Afghanistan. So we look at that and then we say, okay, what is the result of that? What is the result of the waste? It's often to have these unsustainable military budgets. right? When we look throughout history, these unsustainable wars are often a cause for a decline in the value of the currency. And we talked about that in the very beginning with respect to gold, how it's breaking out versus fiat assets. So I think we should keep that in mind as to the monetary implications of these wars. These wars really are a drain on our collective capacity as a civilization. That's the first thing. I think the second thing for how it impacted my outlook is I look to give analysis that is really tailored to decision makers. What do I need to know? Let's not talk about a whole lot of different stories. When I was overseas, we could look at 100 different stories on the ground. What are 100 different quote unquote terrorists doing on the ground at a specific time? Where are they planning to be the next day? What are they planning to do? Yes, those are the fundamentals. It's all important to know, but ultimately it's about where does the rubber meet the road? What is actually happening with respect to the control of the territory? What is actually happening? Are we winning or losing, basically, the battles? That's what it comes down to. So how this impacted my outlook on the markets is when I'm speaking about the markets, I don't like to get into too many stories about the fundamentals. Ultimately, what I like to focus on is, are we winning or are we losing the battle so that investors can make the best decisions for themselves? The place that we see where we are either winning or losing the battle is in the price of the asset. That's where the rubber meets the road, the price. And so I focus foremost on the price. That determines if we're winning or losing. We talked about gold breaking out versus fiat assets. It's winning, but we don't yet know if gold is going to break out versus industrial or productive assets. We have to keep open to that. And the price of the thing is going to be the foremost to focus on in making those determinations. So thank you very much, for letting me speak on that final point. I think it's really important for investors to ultimately focus on price and not get lost in a whole lot of stories. And it's also quite a meaningful backdrop of how I arrived at this point.
Well, thank you for sharing that with us, Christopher, and all the knowledge you've shared during this interview. We really appreciate you joining us. And before I let you go, for those who want to learn more, could you tell us about iGold Advisor and what you do there?
Yes, thank you so much. iGold Advisor is the website. You can also follow me on Twitter. The Twitter handle is @iGlobalGold. I'm fully independent. I work with individual clients all the way from complete beginners, people who have never purchased a single ounce of gold or silver before. I do not take any sponsorships or fees from any of the dealerships. I just look out for the interest of individuals. I also work with high net worth individuals in planning customized strategies. We do funding, we do private placements, a whole lot of other ways that investors can get involved.
Great. Well, I'll put a link to the iGold Advisor website as well as your Twitter in the description below for people who want to check that out. Thank you once again for joining us, Christopher, and sharing all your knowledge with our audience.
Thank you so much for having me.